Welcome to the Passive Income Machine podcast, where we show you how to break free from the grind and achieve real financial freedom in 10 years or less. My name is Ryan D. Lee, and I've helped thousands turn income into cash flow, trade fake money for real assets, and take back control over their time, their wealth, and ultimately their life. Each week, you'll get strategy, tools, and mindset to build your own passive income machine. So my friends, sit back, relax, and enjoy today's episode. All right, my friends. Welcome back to the Passive Income Machine podcast. You are on the microphone today with me, Ryan D. Lee, and the man of gold, the paved path all the way to gold, Mr. Scott Saunders. What's going on, Scott? How you doing today?
Ryan, great to be with you. I'm not sure I meet all that, but we will talk about that subject. It certainly is a big topic right now in the news, for sure.
Well, I tell you what, before we get into the big topic on the news, my friends, if you listen to this podcast, number one, thank you. But number two, we were on a little break. We were on a little break because last week we had the biggest launch of our entire lives. We just barely launched and released our brand new best-selling book, Retire in 10 Years or Less. You're going to hear a lot more about that in coming episodes and coming podcasts, but this represented 10 years worth of work, of dedication, of commitments, of clients served, of a strategy proved to help you truly do exactly what the title says. Retire in 10 years or less by securing your passive income machine and creating 6 figures or more of tax-free income for the rest of your life. Scott, before we dive into the topic of conversation today, anything you want to say on the launch of the book?
The launch of the book was just fabulous. So we had a summit where you brought in speakers from all different sorts of disciplines, people that have experience in real estate, insurance products, people that are professional athletes. I mean, it was a phenomenal event, and you really brought in some people that had great nuggets of wisdom to share with everybody. But the cool thing, as you said, your book that you've been working on, kind of your life's work for the last decade plus of consolidating all these concepts, it finally made it out to the masses, and it was just exciting to see the book hit, and then to see people on Amazon. There are literally, for everybody listening, thousands and thousands of copies of this book have already been sold. So, Ryan, tip of the hat to you and taking the time to distill your knowledge and your wisdom and putting a clear path together. And, I would just do a shout out here for anybody listening to this. If you haven't picked up the book, grab the book. It's got the basics all laid out, and it's got a phenomenal companion course. And I don't know if you want to open that up a little bit, but there's a course that goes along with it. So sometimes you buy a book and you get new insights and you go, that was really great, but what do I do next? You've kind of brought a whole ecosystem in place to get people with more information and a way to process that. You want to talk about the companion course? Because I think it's really a phenomenal tool.
Yeah, you know what? It's a one-of-one book. I mean, there isn't a book like it. Number one, the strategy that we share, I don't know if I've ever heard anything like it. I mean, there's things that resemble elements of it because we talk about real estate, we talk about life insurance, we talk about taxes, we talk about Wall Street. But it's a one-of-one strategy in how we generate 6 figures of tax-free income. But more than that, it's exactly what you said. I've read so many books over the course of my life, and there have been some defining ones for sure. But I'll never forget when I read Rich Dad, Poor Dad. It shattered my worldview around money. Everything I thought I knew about money, I realized was wrong. But I didn't know what to do, right? Just because I knew something was wrong, I didn't know what was right. And I stumbled around with that lack of knowledge of what to do next for quite some time. And that was both costly, right? Because I made some mistakes, right? Taking my money off Wall Street and doing real estate just because, of what Robert Kiyosaki said. I learned some lessons the hard way. And so my objective with the book was to give people a perspective shift, a paradigm shift, and then give them a roadmap of what exactly to do with it. So that's really what the companion course is. It's called the Launchpad, and it'll take everything that you have learned in the book and it'll help you launch it. It'll help you run your numbers, calculate your financial freedom pathways, see how you can generate 6 figures of tax-free income, and more than anything, know why you're stuck with money today. And more than anything, know what to do with this knowledge to become unstuck, to retire in 10 years or less. So that's really what I wanted to say is let's get to the topic today. I wanted to acknowledge the fact that we've been off. We love doing our podcast, but we just could not fit it all in last week. It was an amazing launch. But today we're going to be talking about Wall Street. Scott, I love throwing rocks at Wall Street. I really do believe they're the enemy. Now, most people on Wall Street are good people, right? Financial advisors, they're good people doing the best they can, but they're leading people down a pathway where they will never get what they want. And that's not hyperbole, that's reality. The statistics prove it, right? But yet, for whatever reason, and this generally does baffle me. I mean, despite the lack of results, everyone follows the Wall Street pathway to some degree. They still put their money in mutual funds. They still max fund their 401k. They still hope it's going to work out. But Morgan Stanley just did something that's a little bit telling of what they're seeing and why they're making such a bold pivot. So, Scott, tell us what Morgan Stanley just did and why this is relevant to the times that we're living in right now.
Yeah, so here's what they did. It's a big change. So a lot of people have probably heard of a typical 60-40 allocation, right? Put 60% into stocks, 40% into bonds. And this has been kind of conventional wisdom from Wall Street for decades and decades. That's kind of a formula that they've talked about and said, this is the ideal allocation. Well, here's what happened. Morgan Stanley came out within the last week or two here, and they came out and they changed their allocation. And what they recommended was, instead of going 60-40, they recommended 60% in stocks, 20% in bonds, and lo and behold, the remaining 20% in gold. So they changed their official recommendation. And that's a big change to have people at Wall Street do that. And we could talk a little bit about why I think they did. I think some of that is just acknowledging that we've got these economic forces. We've got something called inflation that is a train barreling down the track. And I think it's affecting a lot of people. And to me, when I look at the reason why they made that change, they're acknowledging inflation's a variable here. And we have to do something to counter the effect of inflation. We got to do that. And so they're going to recommend to their clients putting 20% of their assets into gold as an allocation. And that's historic. That's a big deal. We really haven't seen financial firms recommending that as a mainstream advice. You know, people might say put a little here and there, but to me, that's an acknowledgement that inflation's a factor and their traditional recommendation doesn't work. How do you kind of see their recommendation changing, and why have they done it?
Yeah, I agree with you on both fronts, and I want to actually kind of dissect this a little bit. I was typing in, man, I love ChatGPT. It's so crazy. I can look up information on the fly because as you're talking, I'm like, how much money does Morgan Stanley manage? According to ChatGPT, Morgan Stanley has $7.9 trillion of assets under management. So what that ultimately means, if they're recommending a 20% allocation over let's just say everyone follows the recommendation, right? Over the coming months or years, that means they're going to move $1.5 trillion out of equities or bonds into gold. That's a lot, man. That's a big, big move. And it does signify the problem that you face. And when I say you, I'm talking to the listener. If you're following any form of Wall Street's, financial advice, the biggest challenge that you're up against is you're up against this thing called inflation. We all know it exists, but yet Wall Street's reaction isn't really giving you a solution. They're just kind of trying to help you. They're trying to help you manage a problem that inevitably exists. Meaning, you've got your money in equities and you're hoping that you can earn a higher rate of return to outpace inflation. But there's a lot of speculation. There's a lot of talk right now that the stock market, if you really go one level below the surface, over 50% of the gains in the stock market come down to 7 companies. There's a lot of inflation in the stock market, and they're trying to pivot, moving to a hard asset that will give some stability to people's portfolios. So I think, number one, not only are they signaling to inflation, number two, they're signaling to a future correction or a future loss of value in the Magnificent Seven. What are your thoughts on that, Scott?
Yeah, I think you're absolutely right. There is a high concentration. I know people look at the stock market and see that it's going up and up and up. But there's another way to look at the stock market too, is you can measure it in gold. How is the stock market up when you compare it to gold? So when we compare it to a dollar, the numbers are getting bigger. When we compare it to another measure, right, gold being one, you can compare it to silver, you compare it to oil. There are all sorts of commodities. the stock market, when you compare it relative to gold, isn't up all that much. And I think that's kind of, I think we're just seeing a world now where things are changing. I think the financial institutions are realizing that old tired formula doesn't work, and they're tossing other things out. And I don't know if this is the right recommendation. It probably is one prescription, and I think what you said, it probably gives them, a little bit of way to counter it. But does it really solve the problem of inflation? I personally don't think it solves the problem. It just identifies that what they were saying before clearly doesn't work. So now they're saying, okay, let's reshuffle the cards. We'll come up with a mix that maybe is a little bit better, or maybe it masks the problem and it gets a little better outcome. But man, we're all still sitting here facing the ravages of inflation. It's a variable that's out there that affects all of us. And that's, at the end of the day, what we need is we need solutions to deal with that thing called inflation. That's what the average person, the average investor needs.
So before we pivot away from gold, I want to actually go just a little bit deeper on this. Next week, Scott, inside of Money Mastery, our high-level group of people that we help achieve financial freedom in 10 years or less, we have a level of people that we talk to that have been in our program for years. I mean, years and years. And next week, we're actually going to be talking about gold as part of an optimized portfolio. But the way we talk about gold is going to be different than the way Morgan Stanley talks about gold. If we just go to the core, the way you and I think about gold is we look at gold as a hedge, right? And the purpose of a hedge isn't to gain or lose. It's to protect us against economic uncertainty with the medium of exchange that we're using, the dollar bill, right? The dollar bill is extremely volatile. The value of it has been and will continue to plummet until it goes to zero. And gold is a way to hedge against the chaos, the uncertainty, the loss of value of the dollar. But when we talk about gold, Scott, how do you and I recommend people having, owning, and holding gold versus probably what Morgan Stanley is talking about?
Well, I think probably holding it in a physical way, right? Having physical gold as a hedge. I haven't looked at their recommendation. Are they recommending that, ETFs and, financial instruments versus physical gold? But I think clearly it's a hedge to preserve what you've already built up, right? That's what the mechanism of gold is. It's a hedge and a store of value to kind of protect yourself a little bit from economic uncertainty. So for sure.
Let's just take a stab at this, right? Let's take a stab at this because let's just assume, I'm going to go back and do some math here really quick. We said 1.5 trillion is what they would move to gold. What would 1.5 trillion by one? That'd be $150 billion in assets under management fees if they recommend people hold gold on their own. So for sure, there's no way Morgan Stanley's telling people to hold gold on their own. They're telling them to put it in an ETF so they can manage it for them and charge them a fee for holding the ETF of gold. And so I think this kind of comes down to the problem, right? The problem is Wall Street wins whether you win or lose. Now, are they trying to do the best for you? Maybe, right? But their interests are placed above your interests. Now, again, I'm going to come back to the beginning. I believe most financial advisors are truly doing the best they can. They don't know another world. They don't understand money. Therefore, they recommend things that really go in alignment with powers that be. And Wall Street is the traditional method of managing money today. But the solution, if you want to retire in 10 years or less, if you want to take control over your money, what you really need to look at and see beneath the surface is they're acknowledging that there's a problem. They're acknowledging that inflation is causing the erosion of the value of your portfolio. But on the flip side of this, Scott, in our world, number one, we tell people to buy assets that work with inflation. So inflation actually makes you wealthier. We don't want to spend too much time talking about those assets on this podcast. But number two, once we've built a system that gets wealthier because of inflation, we want to offset the risk. We want to counterbalance the risk with real hedges. And the reason we own gold, the reason we have it in our possession is we need a medium of exchange that holds its value against a declining dollar. And so gold isn't necessarily, or a hedge in general, isn't necessarily made to be more or less valuable. It's made to hold its value. It's made to hold its ability to exchange. And, we've done presentations on this over the course of time. Back in the day, you could basically use gold to buy, one gold piece could buy you what, a suit, a tailored suit. And today, the same gold coin would still buy the same goods and services, right? The price of those goods and services have gone up, but the value of gold in and of itself, the hedge against the dollar, it's maintained its value. That's really what a hedge is. And I think that's what Morgan Stanley's missing. Morgan Stanley realizes that inflation's a problem. They realize that, volatility in the stock market is going to be probably more volatile rather than less in the coming future. And they're trying to peg some stability into people's portfolios using an asset class like gold. But what they're missing is the underlying reason and the underlying purpose of gold in comparison to what people are trying to accomplish. Let's take a minute and unpack that for a minute. Scott, what are your thoughts on that?
Yeah, well, I would agree with you. There's certainly the way they're going to recommend it is one that benefits them, and they're skimming fees off of it. And I will tell you on the bigger picture, if I look at, Morgan Stanley, and we just look at what's going on in the world today, a lot of the central banks, you know what they're doing? They're upping their gold, right? They're picking up more hedges. In fact, we just recently in the last few weeks crossed over where the banks now have more gold than they're holding U.S. treasuries. So the central banks are signaling that what they're doing is they're bolstering their hedge of the physical thing, and they're lowering the amount of U.S. treasuries. So when the banks all over around the world are doing that, central banks and countries all over the place are doing it, it tells me that the powers that be, the players that kind of look with a long-range perspective, they see things and they're adjusting their portfolio in a way. And we as investors might want to take notice of what they're doing. There's probably a reason why they're doing that. And maybe it's a good idea that, whether you like central banks or not, I personally not a big fan of them, but I like to be observant and study what they're doing. And that's to me a signal that, hey, if I want to do what the big dollars are doing and the big boys are doing, maybe I should take notice, and maybe I should do something that kind of follows alongside what they're doing.
Probably a signal that Jerome Powell is about ready to crank down interest rates and they're about ready to start printing money again. And due to the fact that we're already just a massively inflated in our dollars, the total money supply and the debt to GDP, I think this is who knows, but it seems like a last-ditch effort as they crank up the printing press yet again. So I don't know where we're going with that, my friends. We thought it'd be interesting to bring it to your awareness because, look, at the end of the day, you can't solve a problem that you're not aware of. And our recommendation would be become aware of the financial problem, because at the end of the day, Scott, we just got done, at our live event and then releasing the book. If we really break it down to its core, money, the way we understand it, it's just a piece of paper. It's a medium of exchange. But if we go one level deeper below money represents our time. It's something that you're already trading your time for. And if we really want to go one level deeper below that, time is your life. When your time ends, your life ends, right? And so you're trading your life for money. It's critically important that you understand that, because if you know you're trading your life for money, then in increasing your financial intelligence, understanding what money is, what these moves mean for you, and how to profit from them rather than be left behind because of them, allows you to buy back more of your time, which allows you to take ownership more of your life. Our recommendation is become a steward over your money. No one will ever care more about the success of your financial plan, including Morgan Stanley, than you do. And step number one of becoming a steward over your money is taking it off Wall Street. That doesn't mean you don't put it back on, but if you do put it back on, you're not speculating, you're investing. You're not hoping, you're doing things very intentionally. And that's what the big boys are actually doing. When they're repositioning their portfolios, they're doing it because they understand economic trends. They're doing it because of the profit that's going to come from the moves they're making, versus most people that are just sitting back saying, I hope Morgan Stanley in my 60-20-20 portfolio has my best interest in mind, and I hope it all works out. That's not a strategy, my friends. That's gambling. That will never lead you to freedom. This channel exists, this podcast exists for your freedom, to use money as a tool to buy your life back. Scott, why don't you give us the closing word on this podcast, and then we'll close it down.
That closing word would be take ownership over your own finances. Get that financial education, study it, and take ownership over what you're doing and be strategic. So look at the signals, look at the marketplace, look at the changes, and don't just follow the herd. find out what's really going on, and begin to take ownership for your own finances in small ways. And one thing that I think is a key, it could be incremental, right? None of us financially take this ship and immediately end up with a whole new trajectory. So make incremental moves slowly and surely, and begin to align with the principles, and realize it's not going to happen overnight, but you can get incrementally ahead by making smart decisions along the way. So that'd be my input.
All right, my friends, there you have it. There you have it. Get your wealth off Wall Street, get incrementally ahead. Join us on the next episode.